Hello, brothers and sisters. Hope you all are doing well and your study goes good. Okay, so today we are going to discuss IAS 21 effects of changes in foreign exchange rate. Most of the students have asked me why you have not uploaded IAS 21 lecture. The core reason of uploading this lecture now because there is no point if I upload this lecture previously because there are few standards which I would like to upload before this standard. That's why I kept to decide this lecture at the end. Now we are just left with IFRS 9 financial instrument and consolidation, which I will upload in this week. After that, we will move to current issues and APM. These are small topics which will be covered easily in 2 to 3 days. I am talking about current issues and other APM advanced performance. Okay, after that we will start solving the past paper questions. So if you are not watch IAS and IFRS lecture, then you may face difficulty in solving the past paper questions. Okay, IAS 21 effect of changes in foreign currency or foreign exchange rate is all about, let's say you are purchasing an asset now and there is a possibility that the exchange rate may fluctuate. So what will be the implication? Or you are going to sell an asset and what will be the implication if the foreign currency changes? So all the effect of changes in foreign currency will be learned in this IAS, which is IAS 21. We will read about the functional currency and the presentation currency. Functional currency is the currency in which the entity is operate or based, and presentation currency is the currency in which the entity present its financial statement. If I talk about from group point of view, let's say there is a parent company and there is a subsidiary company. Subsidiary company is located in far land and parent company is located in D land. Of course, parent company will use its own functional currency and presentation currency. Same goes for the subsidiary company. But from the group point of view, subsidiary company should have to use the parent company presentation currency for the presentation of the group financial statement. We will cover this thing in detail once we move to the consolidation topic. Okay, in this IAS, we will read about monetary and non-monetary items. Monetary items are such as related to cash, let's say receivable, payable, and cash and cash equivalent. Whereas non-monetary items are such as assets, non-current assets or current assets. In the non-current assets, property, plant and equipment, intangible assets. In the current assets, inventory, like this. Okay, so we will learn the implication, the reporting of the current as of the monetary and non-monetary items. Let's read effects of changes in foreign exchange rates. Functional currency. What is the functional currency? You have to read this thing because the examiner can ask this thing in a theory question. The functional currency is the currency of the primary economic environment where the entity operates. In most cases, this will be the local currency of that specific region. An entity should consider the following when determining its functional currency. One, the currency that mainly influences sales price for goods and services. The currency of the country whose competitive force and regulations mainly determine the sales price of goods and services. The currency that mainly influences labor, material, and other costs of providing goods and services. These first 3 points are the primarily points, or you can say primary factors, which you have to consider in determining the functional currency. Based on these factors, you will determine whether the functional currency is this or that. Now, from 4 to 5, these are the secondary factors. The currency in which funding from issuing debt and equity is generated, the currency in which receipts from operating activities, again repeating, operating activities are usually retained. Now, the first 3 points are seen to be primary factors in determining functional currency. The entity maintains its day-to-day financial records in its functional currency. Now, what is presentation currency? Presentation currency is the currency in which the entity present its financial statement. I have given you the example of parent company and subsidiary company. This can be different from the functional currency, particularly if the entity in question is foreign-owned subsidiary. It may have to present its financial statement in the currency of its parent. Remember the Farland and Dealand example. Even though that is different from its own functional currency, we will solve the questions, then you will get the more clarification. Now, non-monetary and monetary items. Monetary items, non-monetary items. Monetary items such as cash, amount to be received or paid in fixed and determinable amount of money. Receivables, payables, loan notes. Non-monetary items. All assets other than monetary assets. Other than these. Property, plant and equipment, intangible assets. Now, there are rules for the monetary items and non-monetary items. Let's read the rules for the monetary items. Monetary items, they are recorded at exchange rate of transaction date. And if that monetary item not settled, means not paid or received by the year end, then will retranslate. Then you have to again translate it, that monetary item, using exchange rate of year end, and any exchange gain loss of monetary item is reported in P&L. Let's solve the question, then you will get the more clarification. Question number 1. Company A has a business in UK, means company A operates in UK. The local currency, the functional currency is pound, GBP. Also, the presentation currency will be in GBP. Okay. Company A has a business in UK, sold goods on 6 months credit at $300. Remember, $300. It's not GBP. Means they are dealing in dollar. But for the purpose of its presentation, it will have to record or convert it into GBP. On 1st October 2001, payment will be received on 31st March 2002, means after 6 months on the sale, the payment will be received from the customer. Exchange rates at 1st October on the transaction date, £70 per dollar. 31st December year-end date, £75 per dollar. 31st March on the payment receipt date, £78 per dollar. If you can see, the exchange rates are increasing. So what do you think what do you think if exchange rates are increasing? So there is a possibility that we can receive more cash. If we receive now, then we will get the cash based on 70 rate. If we get the cash on 31st December, then on 75. If on March, then on 78. Now solve this question. 1st October 2001, account receivable debit, sales credit, as you sold on the credit. So account receivable is debit and sales credit, as you sold on a credit, so that's why you debit the account receivable, means you still have not received the cash. And we just learned in the monetary items that they are recorded at exchange rate of transaction date. So the transaction date exchange rate is 70, so you convert it into GBP. This is direct quote, as 300 is in dollar and the rate is pound per dollar. So if you multiply, then the dollar is cancelled by this dollar, because this dollar sign is in denominator. I hope I don't have to learn this mathematical concept to you. Okay, so 70 multiplied by 300 is 21,000 GBP. Now it's converted into GBP. At 31st December 2001, if you can see, the exchange rate is now 75. So it means there is a difference of 5 as the exchange rate increased by 5 GBP per dollar. So means there is a gain. That's why we record account receivable P&L credit. Why account receivable? Because still no payment has been received. So account receivable debit P&L credit by £1,500. How 1,500? 300 is the transaction amount and the fluctuation in rate is previously it was 70, but now it is 75. So there is an increase of 5. So 5 multiplied by 300 is 1,500. I have written a note for you. As the exchange rate increased by 5, so we have a gain of 1,500. Means if we received our payment now at this time, the rate is 75, 31st December. Now come to the 31st March 2002 payment received date. Here you can see I debit the cash because we are going to receive the cash from the customer. And at this date, the exchange rate is 78. So 78 multiplied by 300 is 23400. Account receivable. If you can see, the account receivable is 300 multiplied by 75. Why 75? Can anyone tell me? Because last time the rate for the account receivable is 75. Okay, one more thing you can do. On 1st October, the account receivable is 21,000 and on 31st December, the account receivable was 1,500. So 21,000 plus 1,500 is double to 500. So now you are receiving the payment. So you will debit the cash and credit the account receivable by taking the implication of previously gain or loss. So the account receivable is 22500 and the difference is gain. So it means it will be recorded in P&L. The receivable was at 75 here in December, and in March 2002 we received the payment from the customer at 78 as the exchange rate 78. So there is a gain of 9,000 which will be reported to P&L. Now question number 2 is about the payment. It means you are purchasing goods on credit. Company A has a business in UK, purchase goods on 6 months credit at $200. On 1st October 2001, payment will be made on 31st March 2002. Exchange rates are at 1st October £80 per dollar, 31st December £82 per dollar, 31st March 2002 it's £85 per dollar. 1st October 2001 entry goods debit accounts payable credit as you convert or translate it at the exchange rate of 80. So 200 multiplied by 80 gives you the 16,000 pound. Okay. Oh God, what is this? Okay. So at 31st December 2001, now, if you can see, the exchange rate is increasing, and this is the case of purchase, means we are going to make the payment. What if we pay at 1st October? So we will pay at 80. But if we paid at 31st December at this date, the exchange rate is 82. So there is an increase of 2. So now we have to pay 2 rupees extra, £2 extra. So of course it will be a loss for us. That's why P&L debit accounts payable credit as the liability is increasing. 200 is the transaction date, 82 this 31st December exchange rate and 80 on the 1st October 2001. So the difference is 2. 2 multiplied by 200 gives the 400. As the exchange rate increased by 2, so we have a loss of 400, means if we pay our payment now at this time, rate is 82. Now move to the final date, which is the payment date at 31st March 2002. We are going to pay. Now, this is account payable, P&L debit, sorry, accounts payable. Okay, accounts payable debit by 16400 and P&L debit by 600, and the credit is cash. How cash? Sorry, I have changed this line. There is a writing mistake. Accounts payable is 16400. How accounts payable is 16400? The transaction amount is 200 and the exchange rate is 82 at 31st December. So 82 multiplied by 200 is 16400. Now cash is 17,000. How cash is 17,000? Because 200 is the transaction amount and 85 is the exchange rate at 31st March 2002. So 85 multiplied by 200 is 17,000 and the difference is 600, which is a loss, means we have paid 600 extra. The payable was 82 and in March 2002 we pay the payment to the supplier at 85. So there is a loss of 6,000. How 6,000? 200 was the amount and the difference of the exchange rate is 3. So 200 multiplied by 3 is 600, which will be reported to P and L. Okay. Now, question number 3. If partial payment received now you have to be very skeptical because this is a case of partial payment received now. Previously, what we did, we just calculate the difference of exchange rate. But whenever there is a concept of partial payment, make sure the previous method will not follow. Let's solve this question. Please be attentive. Company A has a business in UK, sold goods on credit at $800 on 1st Feb 2001. Partial payment of 500 will be received on 31st July 2001. The year end is 31st December 2001. Exchange rate: 1st Feb 2001, 60 pound per dollar; 31st July 2001, 65 pound per dollar; 31st December 2001, 58 pound per dollar. If you can see, at the receipt date the exchange rate is going down. Now solve this question. Solution: 1st Feb 2001, account receivable debit, sales credit. Same concept as we did previously. 800 multiplied by 60 gives the 48,000. But here is a difference as it is a partial payment received case. 31st July 2001, partial payment of 500 is received. So you debit the cash by 32500. How 32500? 500 multiplied by 65, as on 31st July the exchange rate is 65. So you debit the cash. Account receivable: 500 multiplied by 60. In case of partial payment, you have to use the exchange rate on the date of transaction, not on the date of receipt. I am repeating again, in case of partial payment, you have to take the exchange rate of on the date of first transaction. This is 1st Feb. So 500 multiplied by 60 gives you the 30,000. There is a gain of 2500. As the exchange rate increased by 5, so we have a gain of 2500. As partial payment received now and the rate is 65. Now 31st December, the exchange rate is 58. P&L debit, account receivable credit. Why receivable is credit? Because there is a loss of 2. How there is a loss of 2? Look, this is very important case. This is a case of partial payment. 58 at the date of 31st December, but on 1st Feb it was 60. So from 60 to 58 there is a difference of 2.
That's why I am repeating again, in case of partial payment date, you have to compare it with the rate of transaction date, which is 1st Feb, when this transaction happened. Okay, not with the payment date. So there is a difference of 2. 2 multiplied by 300 is 600 loss. The receivable rate was at 60 at December 2001. Partial payment of 300 is still receivable as we received 500. So there is still 300 receivable. And at this date, the rate is 58, which is reduced by 2. So there is a loss of 600. Now, if you are going to make a partial payment, let's read. Company A has a business in UK, purchase goods on credit at 1200 at $1,200. On 1st Feb 2001, partial payment of 400 will be made on 31st July 2001. The year end is 31st December 2001. Exchange rates at 1st Feb 2001, 70 pound per dollar, 31st July 73 pound per dollar, 31st December 69 pound per dollar. Okay, now solution. 1st Feb 2001, goods debit, accounts payable credit by 84,000. At 1200 is the transaction amount on which we purchase goods. And at 1st Feb, the exchange rate is 70. So 70 multiplied by 1200 is 84,000. Again, I am repeating, in the partial payment received or payment made case, you have to compare the exchange rate with the exchange rate at the date of transaction. Now, 31st July 2001, accounts payable debit, PNL debit, cash credit. First, calculate the amount of cash as we are going to make payment on 31st July. If you can see, the exchange rate is 73. And how much we are going to pay? We are going to pay 400. So 400 multiply by 73 is 29200, but accounts payable is 400 multiply by 70 at the date when this transaction happened, which is 70. So 400 multiply by 70 is 28,000. The difference is 1200. Now, as the exchange rate increased by 3, so we have a loss of 1200 as a partial payment done now, and the rate is 73. 31st December 2001, still 800 is not yet paid by us, as we only paid 1200. The total amount is 1200. Out of 1200 we paid 400. Now we are left with 800. How to account for this 800? Okay, if you can see, the exchange rate at 31st December, the exchange rate is fluctuated by 1 from 70 to 69. It means there is a reduction of 1 pound. It is good for us or not? Yes, it is good for us. Why? Because our liability is reduced, as now we have to pay at 69. From 70 to 69, there is a 1 rupees gain. So we all know reversal of liability is an income, or you can say reversal of an expense is your income. So accounts payable debit, P and L credit, 800. 800. How 800? 800 multiplied by 70. 70 is the date when this transaction happened, 1st Feb 2001. And 800 multiplied by 69. 69 is the exchange rate on 31st December. The payable rate was 70, and at December 2001, partial payment of 800 is still payable, and at this date the rate is 69, which is reduced by 1. So there is a gain of 800. Now we are done with the monetary item questions. If you have any question or any doubt, feel free to ask. You guys just watch the videos and don't comment either you got the concept or not. So I don't have any idea whether your concepts are getting clear or not. So please, it's a humble request, try to comment down. If you guys just comment yes, 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 so I get the idea that you are getting the concept. Now, for non-monetary items, what are non-monetary items? Non-monetary items are assets and liabilities that do not result in a right to receive or obligation to deliver a fixed or determinable number of currency units. Examples: property, plant, and equipment, intangible assets, inventory, investment in equity instrument. Again, investment in equity instrument means shares. Not included receivables, payables, loan, that those are monetary items. IAS21 treatment of non-monetary items measured at historical cost. Translate using the exchange rate at the date of transaction. Once you shift it into the home currency, if you remember previously, we were paid in dollar, but the currency is GBP. So we shift it into GBP. So it means translate using the exchange rate at the date of transaction. Not retranslation in future period. Means once you translate at the date of transaction, then you do not need to retranslate it if there is a exchange rate difference. Measure at fair value. Translate using the exchange rate at the date when fair value was measured. Revaluation date. Gains or losses go to P&L if the item is measured at fair value through P&L. OCI if the item is measured at fair value through OCI. Summary table: type of non-monetary item: inventory, PPE, cost basis for PPE or fair value investments, P&L. Okay, now there is a one summary point of all the above discussion. In simple terms, shift into the home currency, then start depreciation. Let's solve two questions on both models: cost model and revaluation model. Entity A bought a property at a cost of $1,000 when exchange rate is £80 per dollar on 1st Jan 2001. Life is 10 years. At the end of 2002, Entity A sold it at 800 when exchange rate would be £85 per dollar. Step 1: shift into the home currency, which is GBP. GBP. $1,000 multiplied by £80 per dollar equal to 80,000 pound. If you can see, I have crossed this dollar with this dollar. Okay, I have a question. What if the exchange rate is $80 per pound? Means pound is in denominator and the dollar is in numerator. So what will you do? Of course, in that case, you have to divide it. 1000 divided by 80 gives you the GBP figure. Okay, so you have to be skeptical or attentive. Cost equal to 80,000 at 1st Jan 2001. Depreciation: 80,000 divided by 10 gives you the 8,000. Book value 72,000 at 31st December 2001. Depreciation again 8,000. How 8,000? As the remaining life is 9 years, so 72 divided by 9, 8,000. 72 minus 8,000 is 64,000 net book value. Now, if you see at the end of 2002, entity is sold it at $800 when the exchange rate. Now, this is your disposal proceeds, your sale price. You have to convert it into GBP, which is 68,000. Your value of the asset is 64, but you sold at 68, so there is a gain of 4,000, which will be reported in P&L. Let's solve one question on revaluation model. Entity A bought a property at a cost of 2,000 when exchange rate is £100 per dollar on 1st Jan 2001. Life is 10 years. At the end of year 1, fair value is $2,200 and the exchange rate is £120 per dollar. At the end of 2002, fair value is 1800 and the exchange rate is £130 per dollar. If you can see, the fair value is reducing, so you guys can guess there is a revaluation loss, but don't always go with such logic in this IAS, because There are exchange rates, so there is a possibility that the exchange rate of this figure will be greater than this figure. Solution. Step number 1, shift into the home currency. 2000 is the cost, multiply by 100 pound per dollar, as 100 is the exchange rate on 1st Jan when we purchase this asset. Gives the 2 lakh cost, 2 lakh, depreciation 20,000, 2 lakh divided by 10 gives the depreciation. Okay, book value at 31st December 2001 is 1 lakh 80,000 pound. If you remember, at the end of year 1 there is a fair value of 2200. You have to convert it into GBP. 2200 multiplied by 120 gives you the 264,000. Now the book value is 180, but the fair value is 264. So there is a revaluation gain of 84,000. We all know revaluation gain is become part of reserves equity. So the entry is PPE, debit revaluation surplus equity. Also, it will not go in PNL, it will go in OCI. Now in 2002, fair value is 264,000. This one will carry forward, become the opening of 2002. Depreciation, as remaining life is 9 years, so 264 divided by 9 gives you the depreciation of 29,333. Net book value is 234,667. Now, in the end of year 2, there is again a fair value of 1,800 and the exchange rate is 130 pound per dollar, gives you the 234,000. If you can see, the net book value is 234,667, but the fair value is reducing 234,000. So there is a revaluation loss of 667. Now, how to account for this loss? Revaluation gain entry PPE, revaluation surplus. Revaluation loss 667, PPE 667. So it means the PPA is reduces. How much the amount of PP is reducing? There is a net entry. PPE debit by 83,333, revaluation surplus OCI 84,000, and revaluation loss which will go in PNL by 667. So that's it for this topic, IAS21, effects of changes in foreign exchange rate. Again, I am repeating, if you have any queries, any question, please comment down below this video. I will connect with you. Now, if you know, I start writing a summary on each IAS and IFRS. So what I have done with IAS21, I have written down a summary for you. So once you go through these content, then I would highly recommend you to go through this summary notes as well, because it will give you an extra understanding as it covers multiple references: UK GAAP, IFRS, IAS, KPMG, and Big Four accounting manuals. So my recommendation is to you go through this summary notes as well. Okay, there is a question, let me tell you which one. Just a minute. Okay, yeah, this one. This is just a misprinting. I will correct this file which you will get in the drive link. So it's account payable debit 16400, PNL debit 600, and cash credit by 17,000. This is not account receivable, this is a cash. Also, this is 600, not 6,000. So take care and goodbye.